Welcome back. We are starting with Chapter 15 Sole Trader. I will cover this in two parts. Part 1, which will cover the basics of this topic, including the format of income statement and SOFP in detail. Okay, so this part is extremely important to build your basics. And you need to know the formats of these two for a lot of topics that will be covered throughout your course. So this is also a very important chapter. Just like I tell you about chapter number 3, the importance of chapter number 3, this chapter is equally important, okay, because this chapter, which is chapter 15 Sole Trader, will help you in a lot of topics that are to come. Okay, I'll tell you how with time, but remember, this is very important, so make sure you understand everything in detail, and if you don't, please go back, watch it again, and then continue to part 2. Part 2 will have the adjustments which are necessary to prepare the income statement and SOFP in CAIE questions. Part 2 will also cover a past paper question. Okay, I will solve a past paper question once we are done with part 2. So at the end of it, I will solve a past paper question. Let's move on. These are the objectives. You can pause and read these if you want to. I'm not going to read these because I'm going to cover them with you anyways in this video. This is what CAIE wants you to know from this topic. Okay, so moving on. Types of businesses. Okay, in O-level accounting, we will discuss these types of businesses: sole trader, partnership, manufacturing, limited companies, and clubs and societies. The important thing to know here is that chapter 15 Sole Trader will help you in all of these. Okay, these topics will not take time if you have a good understanding and knowledge of sole trader. If you cover the income statement and SOFP in detail in this chapter, you will have a very easy time in the topics that are to come after this. So remember, income statement and statement of financial position is important for any type of business. Statement of financial position is important for any type of business, including partnership, manufacturing, limited companies, and even clubs and societies to some extent. There are minor differences, but I will let you know about those. But these will help you throughout these chapters. Okay, so remember, this chapter, I'm repeating again, is very important for you. Okay, moving on. Let me erase this and move on. Okay, I'm not going into the detail of these topics right now. We will go through the details when we are covering those. Then I will let you know what types of businesses are those. Today we will discuss sole trader only. So a sole trader business is a simple business which is run and owned by a single person. What it means is that there is only one owner and all the decision making is done by that person. Okay, no one can interfere, so it's entirely up to that specific person. Obviously you will have employees. Okay, you're not going to do everything on your own. You can hire employees, but the decision making and the investment, etc., and the ownership is with one person. Okay, moving on. Types of sole trader businesses. Okay, see, what's written here is that how can a sole trader business exist? Okay, you can either be a business that buys goods from someone. Okay, import karke. In simple words, you're buying goods from someone and then reselling it to your customers. Okay, buy goods in bulk and then sell them to your customers. On the other hand, you can also manufacture your own goods and then sell it to your customers. Okay, manufacture and sell. 1 second. Manufacture and then sell. So this type of business is also a manufacturing business in a way. The other ways can be you're not selling any good, but you're providing a service, right? For example, an accountancy firm, okay, a hairdresser, a vehicle repair workshop, and such businesses, right? You can also have a combination business. For example, a hairdresser, even though the primary business is to provide a service, which is which is like you're cutting hair, you're providing facials and all that, but at the same time you might be also selling goods such as the shampoo you're using, you're also selling it to customers. So it's a combination business which provides a service as well as a good. Moving on. Advantages of forming a sole trader business. Okay. It is very easy to set up. Okay. All you have to do is open your doors, rent a shop, even rent a shop. You don't have to own the shop. Just rent a shop, put your products in and start selling. It's that easy. So it's very basic to form. There's very little paperwork required. Okay. The owner has complete control. You are the decision maker. You don't have to ask anyone. You don't have to wait for any opinions. You can do whatever you like. Okay. And all the profit goes to the owner. Obviously, when there's a single person running the business, all the profit belongs to that person. So these are the advantages of operating as a sole trader. Okay. The disadvantages of running a sole trader business. First of all, unlimited liability. Okay, in case your business fails or has to shut down, you will have to pay all the loans of the business from your private funds as well. Okay, the first thing you will do is you will sell off your non-current assets, right? You will sell off your non-current assets. You will use the money in the business bank account. But if some portion of the loan is still unpaid, you will be forced to pay this using your personal fund. As the owner of the business, you might even have to sell your car, your home in order to pay this unpaid loan. So that's what is the meaning of unlimited liability. Limited financial resources. Okay. First of all, capital is limited as you don't have any partners. You are the single owner. So that's the first reason for limited finance. Secondly, banks and people are also not willing to give loans to sole trader businesses because they are not so reliable businesses. Okay. Limited capacity of the individual. Okay. So see, when you are the single owner of the business, everything is on your head. So you have to run the business, you have to deal with the employees, you have to deal with the suppliers, you have to think about the business plan, you have to think about the product, you have to think about marketing it. So it is a lot of work for a single person. So it is obviously a disadvantage because you cannot divide responsibilities with someone else. You will obviously be having your employees, but the decision making and everything will be on your head. Okay. Lack of managerial experience. Obviously, running a business is not easy. If you have partners, you can have a different skill set compared to your partner. You might be good at designing the product, whereas your partner would be better at marketing the product, and maybe he's better at dealing with the employees or the customers. So that's a different skill set, right? So it is helpful to have partners. If you're a single owner, you're doing everything on your own, you might not be good at everything. Okay, let's get real. Everyone is not perfect in everything. You have some flaws and some strengths, right? So that's it. This is the final disadvantage. Okay, the main and important part, the financial statements of a sole trader. We have two statements which we have to cover in this topic: the income statement and the statement of financial position. Okay, the income statement is now called the statement of profit or loss. That's the new name which we have to use, but you can also call it income statement. Okay, the income statement is subdivided into two sections: the trading account section and the profit and loss section. I will show it to you and then it will be more clear. The primary purpose of the income statement is to measure profit or loss the business has made during this year. It is prepared yearly and only shows the figures relating to the current year. Current year's expenses, current year's incomes, current year's sales, and then current year's profit or loss. Statement of financial position is simply a list of all your non-current assets, non-current liabilities, current liabilities, and capital. It is a list on a specific day. Okay. So let's move on and continue with these statements. First of all, the trading account section of the income statement. Okay. As you can see from this name, it is related to the trading of the business, which means buying and selling activities of the business. Okay. So it contains sales, which is the money that you have generated by selling goods. It contains the cost of sales. Okay. The costs that were necessary to make those sales possible. What are cost of sales? Cost of sales are those costs which were necessary to make these sales possible. Okay. And then finally, gross profit. The trading account formula is simply gross profit is equals to sales less cost of sales. Simple, right? This is the money you made by selling goods, for example, $100. Then the cost of sales, the cost that was necessary to make these sales possible. Let's say that was $70. So how much gross profit did you make? You made a gross profit of $30. Gross profit. So this is what is mentioned here. Gross profit is equals to sales minus cost of sales. Okay. Moving on. Okay. Let's talk about cost of sales in detail now. What is cost of sales? I had told you previously it is the cost necessary to make sales possible. Let me explain this using a simple example. Let's say you sold a pen worth $5. So these are your sales, money generated by selling goods. You had previously purchased this pen. So these were your purchases for $2. Okay, you purchased this for $2, you sold it for $5, right? So overall you made a profit of $3. This is your gross profit. So let me put this in brackets to show that we subtract this. What are purchases in this case? Purchases are your cost of sales. If you did not purchase this pen, you would not be able to sell it. So what is cost of sales? The costs that are necessary to make sales possible. So unless and until you purchase something, you cannot sell it. So purchases are your cost of sales in a way. Okay. Let's discuss these important headings that are given here, which are part of cost of sales in a way. Okay, let's read these one by one. First of all, we have opening inventory. This is the inventory that you have available at the start of the year. What is inventory? Inventory are the goods that you buy to resell. Okay, you buy these goods and then you resell them. So if it's a furniture shop, your tables, your chairs, these are your inventory, right? So opening inventory is the value of inventory that is available at the start of the year, which means they were unsold in the previous year. So we will try to sell them during the current year. In accounting, we only include the expenses of the current year in the income statement. Okay, we follow the accounting principles. So opening inventory is the value of inventory available at the start of the year. Obviously, this will be part of cost of sales, right? Because we are going to sell this inventory hopefully during the current year. Then we have purchases. Okay, apart from opening inventory, we will need more goods that we have to sell. So we will purchase more goods during the year. Obviously, when you purchase goods, you have to pay for them. It is an expense. So it will be part of your cost of sales. Purchase returns are not included in cost of sales. You will have to subtract them. If you return some goods back to the suppliers, or maybe they were damaged, or maybe you don't need them anymore, so you will return those goods back. When you return goods back, you don't have to pay for them. When you don't have to pay for them, they are not your expense, so you have to exclude them from the cost of sales section. Goods for own use. Inventory withdrawn by the owner. In simple words, what it means is that the owner takes home some of the inventory. Okay. For example, the owner wanted to buy a table. So what should he do? Should he go to a shop and buy it, or should he just pick one from his own business? He will not go to the shop. He will pick it from his own business. But when he picks it from his own business, we call it drawings, and we cannot include the cost of that table in cost of sales of the business anymore. That will be unfair to the business, right? Because the owner is taking the table for personal use from the business. So we have to subtract the value of that table from cost of sales section. Okay. Carriage inwards. This is the transportation cost that you have to pay on the goods that you purchase. So this is the transportation cost on these purchases. Obviously you have to pay for this. This is an expense. This is the part of cost of sales. Then exclude or subtract closing inventory. This is the inventory that is left over at the end of the year. So if it is left over, means it was unsold. When it is unsold, how can I include the cost or expense of this inventory in the current year? I cannot. When I'm not selling it this year, I cannot include the expense of this inventory in the current year. I will sell this in the next year now. So in the next year, this will become my opening inventory, and then I will include this in cost of sales for the next year, just like I did here. See, opening inventory was included because this was left over from the previous year. Now I will sell this in the current year. Similarly, closing inventory is left over at the end of my current year. I will use it in the next year. So I cannot include this in cost of sales for this year. That's the format. Now I will explain it to you using a simple example. Okay, I can do it here only. Let me pick some random values and show it to you. Let's say I had sold goods worth $100. Okay, my sales were $100. Okay, and the goods that I sold, I purchased those goods for $50, and then I also paid a transportation cost of $20. So what was my total cost of sales in this case? If nothing else is given, there's no opening inventory, no goods for own use, nothing. So this is my total cost of sales in that case, right? $70. 100 minus 70 gives me the gross profit of 30. Okay, let's include more things into it now, such as opening inventory. Opening inventory, let's say I'm selling pens. Okay, let me write here. This is a business of pens. So opening inventory, in opening inventory, I had pens worth $400 available. Okay, this is the value of pens I had available. A business usually doesn't sell just one unit. We are selling multiple units. So the total value of pens I had available at the start of the year was $400. Okay, furthermore, during the year I purchased more pens worth $100. So what's the value of pens available with me? It's $500, right? This is my cost of sales because I paid for these. I paid for the opening inventory in the last year. I'm using it this year, so it's the expense of this year. And then I purchased more pens worth $100. So total cost of sales is $500. And then I sold these pens, let's say, for $800. Sales. So what was my gross profit? Obviously 800 minus 500. 300 was my gross profit. Right? Now let's include more things to this. Let me erase this. Okay, and imagine I had opening inventory 400, purchases were 100. Then after purchasing these goods, I decided to return goods worth 50 back. $50. Should I include this in cost of sales now? No, I cannot. Why? Because I'm returning these goods back. So I will have to exclude this amount. So my overall purchases are worth $50, right? Not $100, because I'm returning goods back worth $50. Then the owner also took pens worth $30 home. So those are goods for own use. Goods for own use. From where will he take this pen? From either the opening inventory or purchases, right? Which is my cost of sales. So if he is taking pens worth $30 out of the business, I will also have to exclude this amount from my cost of sales, right? So I'm excluding that as well. Then carriage inwards, the transportation cost. Let's say I had to pay carriage inwards of $30 to bring these pens into my business, the ones that I purchased here. So obviously I have to include that in cost of sales, because this is also an expense that I had to pay for purchasing these goods. And then finally, closing inventory. Okay, at the end of the year, I looked at my inventory and I figured out that inventory worth $50, yeah, $60 is left over, unsold. So I cannot include this in cost of sales, right? This is the inventory in total that I had, which was worth 500. Then I returned some goods back. I also took home some goods which I cannot include in cost of sales. Then I had to pay delivery charges on the purchases, so I have to include that in cost. And then closing inventory is left unsold, so I cannot include that in cost of sales. Simple. Doing the working of this, I will get the total cost of sales of the year. So let's do this. 400 opening inventory plus 100 purchases plus 30 this carriage which I paid on it. Okay? These are the three things which I will include, and these three things I will exclude or subtract from these values now. So minus 50, minus 30 and minus 60. The overall value of cost of sales is $390. And let's say the goods that I sold, sales were worth $800. So how will I find gross profit? Sales minus cost of sales will give me gross profit. So 800 minus 390 gives me $410 gross profit. Simple. This is how we calculate cost of sales. Okay, moving on. See, now this is the format of the trading account section of the income statement. Okay. In this section, we calculate gross profit. Just now we have discussed about gross profit in the last two slides. We have also discussed about the cost of sales section in the previous slide. Now let's look at it in the format given. This is the format you're supposed to use in your CAIE exams, and you have to learn this format by heart. Okay. So we are trying to calculate the gross profit. The first thing we have to record in the income statement is the money that we generated by selling goods. This. Okay. This is the money that we have generated by selling goods, right? So you will record the value here. I'm just showing you the format. So there are no values in this, but in the question values will be given and you have to put those values here. Then you will subtract any sales returns if they are given to eventually find net sales or actual total sales. Net sales kya hai? Net sales are your actual sales, right? Because these are the goods that you sold. Let's say you sold goods worth $1,000, but your customers returned goods back to you worth $200. So what were your actual sales? Your actual sales were just $800. Okay. So this is what we find, and this is what we have to use in the coming section. Okay. Cost of sales. I have explained this to you in the previous slide. So this is the heading, less cost of sales. So there will be no value in front of it because this is just the subheading. Okay, you can notice we have made two columns. This column will be used for workings, and then we will write the total on the second column. Yeah, in the second column. Okay. So this is the working of cost of sales, and then the final value is listed or noted here. See, let me show this to you one more time. What I mean by that is that, okay, let's continue first with the format and then I will tell you later when we are doing the expenses section. See, cost of sales. First of all, opening inventory. Okay, inventory available at the start of the year. This will be given in the question. Then we add purchases to it, just like I told you. Then we subtract purchase returns from it, because we cannot include things that we have returned in cost of sales, right? Less goods for own use, and I told you why it is being subtracted. Then add carriage inwards, and then less closing inventory. See, so we will follow this format. We will do the working, we will do the calculations using our calculator, we will get a final answer. That final answer will be written here in the second column in front of closing stock. Okay, no need to leave a line. You can simply write the total in front of this here like this. And then what should we do? We will minus cost of sales from sales. This is the money you generated by selling goods. This is the cost that you paid to make those sales possible. So obviously gross profit will come when you minus cost of sales from sales. And then we will get gross profit here. Okay. Erasing this and moving on. Okay, this is an example. Let's read the example. I have made this example myself. I have kept it simple. Okay, there's nothing tricky about this. It's very basic. Okay, see, imagine you sold a pen for $20. Okay, you're selling it, so your sales were worth $20, right? Let me erase this and do it again. Let me make this straight. Okay, so your sales will be worth $20. Okay, you purchased the pen for $10 and paid $5 transportation cost to get it delivered to you. How much gross profit did you make? Okay, so first of all, purchases is an expense because you use your money to buy this. And then you also paid $5 on the transportation cost to get it delivered to you. So the total cost of sales in this case would be, we have only two things. We have no opening inventory, no closing inventory, nothing like that. So purchases, which were worth 10, and then carriage inwards. The transportation cost is called carriage inwards. Okay, remember the term. 5. So our total cost of sales would be $15. You subtract 15 out of 20, you will get $5 as the gross profit. So I have showed you how to simply use the format to calculate gross profit. Okay, this is what we normally do as well. So see, cost of sales 15, sales 20, 20 minus 15 gives us the gross profit. So very basic and straightforward, nothing special in this. Okay, now this is an advanced example. I will do this for you. 1 second, let me move it here. And let's start with this. You had pens worth $200 available at the start of the month. So this becomes my opening inventory, right? Because I had this available at the start of the month. So these are left over from the previous month. This is my opening inventory. Okay. During the month you purchased more pens worth 300. So these are my purchases of the month. So I can simply write purchases here. You returned few pens worth $50 back to the supplier as they were damaged. Okay. So these are my purchases returns, the goods that I had purchased previously. I am returning those goods back. Purchases returns. You paid $20 transportation cost to get the pens that you purchased delivered to you. So this is my delivery cost. In accounting, we call that carriage inwards. Remember the term. Okay. Carriage inwards. The transportation cost that you're paying to bring the goods into your business. The goods that you have purchased, you're bringing them into your business. So carriage inwards. Total sales during the month were $1,000. So sales are given. Okay. You took home pens worth $30 for personal use. These are goods for own use. For own use. At the end of the month, you were left over with pens worth $100. Left over. So which means we did not sell these. These are left over. So these are my, or this is my closing inventory. You understand how we figure these things out? This is my closing inventory. How much gross profit did you make? Okay. I showed you the format to find gross profit. Let me show it to you again. Here. All you have to do is use this format and calculate the gross profit. Okay. So let's continue with that. Even though these things are erased now, but I remember this was opening inventory. Let's do this one more time quickly. Opening inventory. These are my purchases. Okay, these are my purchase returns. This is my carriage inwards. These are my sales. Okay, you took home pens. Okay, this is my goods for own use. And then I also have closing inventory. That's it. Okay, so I can do this quickly. If you know these things, you can do this quickly like this, and then move on and make the income statement quickly. I told you should have 2 columns. First of all, we start the income statement with sales, right? So the value of sales is 1000. There were no sales returns mentioned in this question, so I don't even have to write the heading. I don't have to write less sales returns. No need. Why? Because it's not given in the question. There are no sales returns. So your sales are your net sales in that case. Moving on to the next section, which is less cost of sales. This is just the heading. In this part, we find the cost of sales. So no value will come in any of the columns. This is simply the heading. The cost of sales section starts with opening inventory. Okay, and I have marked all these things, so we know it is 200. Then we add purchases to it, the goods that we have purchased during the current year. Obviously this is our cost of sales because we had to pay money to bring these goods into our business, so 300. Then we returned some goods back, so purchases returns. I have to remove these out of my cost of sales, so I will write less purchases returns. Why will I remove these? Because when I'm returning goods back, they are no longer part of my cost of sales. I'm getting the money back. So 50, and make sure you put them in brackets. Brackets will show subtract, okay, minus. We cannot use minus sign in accounting statements, so we will have to use brackets. Okay, you paid $20 transportation cost, that is carriage inwards, which should be included in cost of sales because this is obviously the cost that you had to pay to bring these goods into the business. Then we have goods for own use. So goods for own use means that the owner took home something from the business for personal use. So when the owner is taking some inventory for personal use, I cannot include that in cost of sales of the business. Okay, that will not be fair to the business. So I have to remove this out as well. So 30, and then put this in brackets because this is going to get subtracted. Closing inventory. Again, closing inventory is also subtracted and not added. Why? Because this is the inventory that remained unsold during the year. So I will quickly write here 100 and subtract this from the cost of sales because this will be used in the next year now, in the coming year. So I will include it in the cost of sales of the next year, not this year. This is left unsold. How can I include this in the expenses or cost of sales of the current year when I didn't even sell these? Okay. Use your calculator and do this working. This will become 500 minus 50, 450, 470, and then 440 and 340. So my cost of sales is 340. You can use your calculator and double check if you want. Okay, and then when I subtract 340 from 100, I will get 660, which is my gross profit, the profit that I made on selling these goods, right? 660, obviously this is in dollars. So that's how you calculate the gross profit of the business. Understood? Any questions? If you have any questions, you can send me a message. I will make an even simpler example to explain this to you then. But I think if you go back, look at the previous slides, look at this again, it will be clear. Okay, it is not difficult. So erasing all this and moving on. Now, the second section of the income statement, which is called the profit and loss account section. Okay, once you have the gross profit, which is this, okay, I'm only showing you the bottom part now, because usually businesses have other expenses as well. Apart from cost of sales, businesses usually have other expenses as well, right? And there are a lot of other expenses such as salaries of employees, right? And then electricity bill, water bill, internet bill. So electricity, repairs, okay, water expense, and you can think of a lot of expenses of any business. When you start a business, you can imagine operating any business and think of all the overhead expenses you have to pay, right? You might also have to pay rent if you don't own the shop. So there can be a lot of expenses. Okay, these are some few basic examples of the expenses. And then one more thing. Okay, even though the primary way in which a business can generate money is by selling goods or making sales, there are some other ways in which you can generate income as well. Okay, there are some other ways, such as, for example, you have an office, okay, and you're using 3 rooms out of the 4 rooms for your business. One room is empty, so you decided to rent it out. So you are going to receive rent for it, rent receivable. This becomes your other income. Okay, there can also be other ways in which you can generate income, such as commission income. Okay, you did something for someone else, for any other business, and they gave you a commission, so commission receivable. And you can think of other examples as well. Any other way in which the business makes money apart from selling goods is called other income. Okay, so in the gross profit, once we find the gross profit, like I showed you in the previous slide, you will add all the other incomes and get to a new figure, which will obviously be more than the gross profit, because you're adding these things to gross profit to get to a new figure. The basic examples are given here: rent received, commission received, discount received. Okay, if anyone gives you a discount, that is also your income. Or profit on disposal of non-current asset. When you sell a non-current asset and you make a profit on that, that's also your other income. Okay, this I will explain in part 2. So don't worry about this right now. Sole trader part 2 is coming after this, which will have all the adjustments. Okay, right now I'm covering only the basic stuff. Then, as you can see, once we get this value, we add a gross profit plus this new value of other incomes and get a new value. Okay, so if gross profit, let's say, was 20,000 for example, and these other incomes were 2,000, my new value will become 22,000. Okay, this is the money that is generated by the business overall. This is by selling goods and this is through other income, right? So this is the money my business has generated. Now I will have to subtract all the miscellaneous expenses of the business, such as wages and salaries, office expenses, rent, insurance, and then motor vehicle expense, selling expense, loan interest. Okay, the loan that you take from the bank or someone, you have to pay interest on that. Loss on disposal of non-current asset. Again, when you sell a non-current asset, you might also have a loss. In that case, it is your expense then. And so on. Depreciation, and this I will talk about these later, and then they will be clear to you. Ignore these for now. Once you have, okay, this was 22,000, the example figure. So let's say all your expenses combined were $12,000. So now, should I add expenses to this or subtract expenses out of this? Obviously I will subtract, and to show subtract, I will make brackets in accounting. So my net profit will be $10,000. This is the final profit my business has made. Final. We can call it profit for the year. We can call it net profit. Okay. As you can see, profit for the year or net profit. So this is the final profit my business has made during the year. And that's it. This is the format of the income statement. Nothing special. Okay. So you just have to learn this by heart. I've told you how you can remember these things. I've given you concepts and logics behind them. But you can also simply just learn this format by heart. Okay. This format is important for 5 major topics in your syllabus. So make sure you know this format by heart as soon as possible. Moving on. Okay. So this is the statement of financial position. The second important statement for businesses. We discussed the income statement just now. This is equally important. Okay. But this is very easy. You don't have to remember the format. It's very easy. It is simply a list of your non-current assets, your current assets, okay, your capital, your non-current liabilities and current liabilities. That's it. List of these things. Okay. You remember the accounting equation, assets is equals to capital plus liabilities. So if you remember that, you can easily make the SOFP, because we have to list down the assets, which are NCA, non-current assets, and current assets. If you don't know about these, please visit chapter 2 and 3 first. I think chapter 3 mainly, or chapter 2 and 3, yeah. And if you don't know what capital is, again chapter 2 and 3 will help you. And liabilities are also of 2 types, non-current and current. So we have to include these 5 things only in the SOFP. See, we list down the non-current assets and total them. We list down all our current assets and total them. We add these two to get total assets. Okay. Then capital section, we record the value of capital. This is your opening capital, let's say on 1st Jan, start of the year capital. Then these are your drawings, the money that the owner took home. Obviously we have to subtract this from the capital of the owner. Again, chapter 2 and 3, I discussed this in detail. And then the profit made by the business is included into the capital of the owner, yes. Why? Because the profit belongs to the owner. He's the single person running the business, so the profit belongs to him. So we suppose that it is included in the capital as he's reinvesting that money into the business, unless and until he takes it home, which is not mentioned here. So when you will do the total, you will get closing capital or the final value of capital as 53,000. Then non-current liabilities, we have a bank loan worth $800 and current liabilities, trade payables worth $200. Add these 3, you will get 54,000 as well. So see, this statement of financial position proves the accounting equation, which is assets is equals to capital plus liabilities. This should always be equal to this. If you have made no mistake in the income statement from where you get the profit, and if you have made no mistake in the SOFP, okay, they will be balanced in that case. This is the basic format of SOFP. It will stay same apart from a change in the non-current asset section. We will need 3 columns. I will discuss this in the second part after this video. So make sure you sign up for that after this. And I think that's it for the basic part 1 of this chapter. If you have any questions, feel free to ask in the comment section. Okay, now let's do a question in which we have to prepare the income statement and statement of financial position without adjustments. So this is how you will get a question. This is how they will give you all the information, okay, in the form of a list. This is the trial balance which we covered in chapter number 6, the final balances of all the T accounts. And then we have some additional information, closing inventory. I told you why closing inventory is given in additional information. And then they've also given us goods for own use here. Okay, let's move this question to open board and continue with this here. So see, let me tell you a few things first. We have to prepare 2 statements, right? Income statement and statement of financial position. position. All right. So, do you remember the elements of accounting discussed in chapter 2? We have 5 elements in accounting, which are assets, liabilities, capital, expenses, and income. 2 out of these are part of the income statement. In the income statement, we record all the expenses and incomes of the business. And in the SOFP, we record all the assets, liabilities, and capital or owner's equity of the business. So simple. Okay. Income statement is used to find profit or loss, and SOFP is used to show the financial position of the business, that what's the value of our assets, how much liabilities do we have to pay, and what is the investment of the owner in the business, right? So let's begin with the income statement first. I will make it here only on the right hand side, but before that, let's identify what's given in the question. We have opening inventory, which we record in the income statement. Let me zoom this in a bit and then move it here 1 second. Okay, so we have never mind, I can just use it like this. Okay, we have opening inventory. We know this is part of income statement. Purchases are also part of income statement. Sales are part of income statement. Return inwards are called sales returns now. Okay, it's the same thing. And return outwards are your purchases returns. Again, both belong to the income statement. Then we have carriage inwards, income statement, cost of sales section. As you know, carriage outwards is an expense. I will tell you about this in a second. Okay, rent again is an expense. If it was mentioned as rent receivable, it would be an income, but it is an expense, and you can also see it's on the debit side. Expenses are recorded on the debit side. Internet charges, expense. Property and building, non-current asset, which should go in SOFP. Machinery, again a non-current asset, which will go in SOFP. Trade receivables are current asset, SOFP. Trade payables, current liabilities, SOFP. Rent received is an income, which will go in the income statement. Cash is current asset, so SOFP. Bank is also a current asset, so SOFP. Drawings are also drawings and capital are both part of SOFP as well, in which we make the capital section. Okay, closing stock is a current asset, so don't forget to record this in current asset, and it is also used in income statement cost of sales section. Goods for own use. Okay, goods for own use should be included to drawings, which will make the value of drawings 600 plus 300 is equals to 600. Okay, and then they are also part of your SOFP and income statement both, because we have to subtract drawings in the SOFP and also include goods for own use in the cost of sales section of the income statement. Why did I add 300 to drawings here? Because this 300, which was actually given in the question, was not for goods for own use. This was maybe showing the money through cash or bank that the owner took home. This was that. Now, furthermore, Selma took inventory worth $300 for her personal use. No entries were made in the books. What it means is that it is not shown in the trial balance here. So I've included it now, and the drawings are 600 in reality. Okay, 300 were cash drawings and 300 were goods for own use. Okay, let's start making the income statement. You should be knowing the format by heart when you prepare income statements. So the heading will come here, income statement. Okay, for the year ended, whatever date is given, this is an example, so no dates are given, but we always have to write for the year ended, and then let's say 31st December 2025 or whatever the date is. This is just the heading of the income statement. Then we make two columns. Okay, one is the working column and one is the column for totals, right? Now let's start putting things here. The first thing you have to put in the income statement is the value of sales. Okay, so let's see. This is the question. Okay, this is the question. So we will use this list to put values here, and for that we should know the format. So sales are worth 100,000, so I'm writing here 100,000. Okay, then we have sales returns given as well. So according to the format, I should minus sales returns from this. The value of sales returns is 200, so I will subtract 200 from this, and I will get net sales, or the actual sales that the business made this year, the money generated by selling goods. Okay, so this will become 99,800, right? Once we have the value of sales, we will move on to the next section, which is less cost of sales. I have explained this in detail in this chapter now, so I'm not going to go through that. I will just write the things. First of all, we need opening inventory. We will use the working column. So the value of opening inventory given in the question is 13,000. Okay, we will add purchases to it. The value of purchases is 40,000, right? We will subtract purchase returns from this, less purchases returns, and the value is 2,000 here. So put this in brackets to show that this is subtracted. Then we will less goods for own use, goods for own use. The value was $300 given in additional information, so I will put this in brackets, right? Then we have to add carriage inwards, the transportation cost that we had to pay in order to make the purchases. So carriage inwards was 200, and then in the end I will subtract closing inventory, and you should be knowing why. Closing inventory, the value is given in additional information, 6,000. Okay, use your calculators and find the cost of sales. So 13,000 plus 40,000 minus 2,000 minus 300 plus 200 minus 6,000. 44,900 is the cost of sales. I will write it in front of closing inventory but in the second column. This will represent the total of cost of sales. Okay, and I will put this in brackets. Why? Because I have to subtract cost of sales from sales to get the gross profit. The profit that the business made by selling goods. Okay, this is the gross profit. So 99,800 minus this will give me the gross profit. 99,800 minus 44,900 is giving me 54,900. I'm done with the trading account section of the income statement, but the income statement is not complete. I have told you we have to include some other incomes and also subtract all the miscellaneous expenses of the business from the gross profit amount. So let me move this down a bit. Okay, and then continue. Let's see, do we have any other income in this question? I think we had one. Yes, here rent received. We have just one other income given. Do we have any other income? Let me double check. Okay, we have just one. So put the heading add other income. Underline this because this is the subheading. No value will come in front of this. And then mention rent received and write the amount, which is 3700. Okay, we had just one, so I'm not using the totals column, sorry, the working column. I'm just simply putting the value in the totals column because we had only one other income. If we had two, I will add them first and then write the totals in the second column. So let's total this. 54,900 plus 3,700, 58,600. This is the value of my gross profit after adding other income to it. Okay, these two are added together because this is the other income of the business. This is the income generated by selling goods, and then this is the other income that we generated. So the total money the business made is 58,600. Now we have to subtract all the expenses of the business. So the expenses are starting from here. Let me make a star on the expenses just to show you. I have written EXP or E in front, but let me show you. Carriage outwards, rent, internet charges. Okay, only 3 expenses are present in this. Let me double check. Yeah, only 3 expenses. So we will list them down and total them. Okay, what is carriage outwards? As you can see, this is written in red. I told you what carriage inwards is. Carriage inwards, let me first tell you about carriage inwards so that you can differentiate between the two. Carriage inwards, I'm writing it here, carriage inwards is the transportation cost that you pay on purchases. When you purchase goods and you have to bring them into your business inwards, okay? Carriage inwards, goods coming into the business. So it is a transportation cost paid on purchases, purchasing goods, when you purchase goods. Okay. On the other hand, carriage outwards is the transportation cost which you pay on the goods that you sell. So this is on sales, the transportation cost that you pay on the goods that you are selling. Okay, this is not part of cost of sales. This is part of other expenses of the business, right? Because for example, you give free delivery to customers. This is that one. Okay, the carriage expense that you have to pay on deliveries to customers. So carriage outwards, goods are going out of the business to customers. So it is an expense of the business if you provide free deliveries. If you charge this from the customers, then you will not have any carriage outwards. Okay, but you know businesses usually give free deliveries. So who pays for those deliveries then? The business, and that is called carriage outwards. Okay, so let me erase this to not overcrowd the space and then move on with the income statement. So as you can see, we have only 3 expenses. We have carriage outwards, so I will make the heading first, less expenses. This is the last subheading. No amount will come in front because this is just the heading. And then moving this down, I have to record 3 expenses. Carriage inwards, so let me write that first, carriage inwards. What's the amount? The amount is 500. So let's use the first column, 500. Okay, and then we have rent expense, which is 3000. So I'm writing it here, rent expense 3000. And then internet charges. Internet charges. The value of internet charges is how much? It is 1500. Okay, let's total the 3 expenses. 3000 plus 1500 plus 500. I'm getting 5,000 as the total of expenses. So now the expenses will be subtracted from this amount. This is the income that the business has generated overall by selling goods and through other incomes. And obviously you have to subtract the expenses of the business from that amount to get the net profit or profit for the year. Profit for the year. This is the final profit that your business has made at the end of the year. Okay, so 58,600 minus 5,000, one second, gives me 53,600. This is the profit my business has made. Let me zoom this out and show you the entire income statement in one go so that you can see how the working is done. Okay, this is the income statement which I have prepared in front of you. In this section we find the value of sales, the actual sales, then we work out the cost of sales, and the final value is deducted from the net sales to give us gross profit. Then we add any other income of the business to it to get a new value, and then minus all the miscellaneous expenses of the business from it to get profit for the year. The purpose of making the income statement is to find profit or loss of the year, and that's what we do in the income statement, as you can see. Okay, let's move on to the statement of financial position. Okay, let me move myself to the other side. I think I might be blocking the view here, so one second, let's just move this here and continue with the statement of financial position. So let's erase all this and make the statement here. We have to keep in mind and remember the profit. So let me write it here, the profit, because we have to use this in SOFP. Profit is 53,600. Okay, let's move on. Let me erase this and start making the SOFP, statement of financial position. Okay. Statement of financial position. This is made on a specific date. So we simply write as at and any date. For example, 31st December 2025. Okay, this is the statement of financial position on that specific date. The first thing we start the statement with is the non-current asset section. You simply have to list down your non-current assets in this section. Very straightforward. Let's make 2 columns for now. When we will do adjustments, we will make 3 columns, but for now 2 are fine. So the non-current assets that we have mentioned them here. We have property and buildings. So let's record that first, property and buildings, and the amount is 500,000. And the other non-current asset we have is machinery. I hope you know what non-current assets are. Otherwise, go through chapter 2 first. Machinery is worth 40,000. See, I'm just reading the values from here and putting them here. So all these things will be given in the question. You should just know the formats of the income statement and SOFP. So what's the total of assets? It's 540,000. So I will write this in front of the last one, which is machinery, and in the second column to show it's the total of both assets, right? So total of non-current assets is 540,000. Moving on to current assets. Okay, so first of all, I will write closing inventory, which is given here in additional information. Closing inventory is always given in additional information because we cannot include that in the trial balance. Closing inventory 6,000. Okay. Then we have, did I mark all these? Yes. We have trade receivables 20,000. So trade receivables 20,000. What else do we have? We have cash and we have bank. So cash is 800 and the money in our bank account is 14,000. I think that's it for the current assets. Let me double check quickly in case I missed any. Trade receivables done, this done, this done, and closing inventory done. So I think that's it for the current assets. Let's total them. 20,000 plus 6,000 plus 800 plus 14,000. 40,800. So again doing the same thing in front of the last current asset, I will write the totals in the second column. 40,800. Okay. So let's total the assets. Total assets. Okay. So 540,000 plus 40,800 gives me 580,800. This is the value of total assets. Okay. Moving on to the next section, which is capital and liabilities section. The first thing we start this section is with the value of capital. Okay. So let's write down the value of capital. It is always given in the question. The value is 497,800. 497,800. We have to subtract drawings from it. Okay, part of the format. You should be knowing the formats. So drawings were 600. I will subtract those, and then we add profit for the year to this because the profit belongs to the owner. So 53,600. Let's do the working for this using our calculator. 497,800 minus 600 plus 53,600. The value is 550,800. 550,800. Okay, let's move on. Let me erase this. This is left over from the last income statement. Okay. So we're done with capital. Now we have to include the non-current liabilities. In this question, no non-current liability is given. As you can see, there was no non-current liability. You should know what non-current liabilities and current liabilities are. If you don't know, visit chapter number 2. And in the timeline, you can see I have mentioned where these things are present. So you can simply click and go directly to these things or whatever you want to know from that chapter. Okay. So there are no non-current liabilities, but we have a current liability, which is here, trade payables. So I will write down the heading of current liabilities. No need to mention non-current liabilities when they are not given. We can simply skip that heading and move on to current liabilities. We have one current liability, which is trade payables. And when we have just one thing in a section, we will write down the amount directly in the second column. So it's 30,000. As you can see, let me show you here. So now I will add capital and liabilities. 550,800 plus 30,000 will give me 580,800. And what will I call it? I will call it total of capital and liabilities, or in simple words, total capital and liabilities. And as you can see, let me zoom this out and show it to you. As you can see, the total of assets, which is this, is equal to the total of capital and liabilities. And you remember the accounting equation states that assets should be equal to capital plus liabilities. This accounting equation, which we did in chapter number 2, is proved in the SOFP, as you can see, only if we make no mistake in either the income statement or within the SOFP. Why can't we make a mistake in the income statement? Because we picked this profit figure from where? This one. From the income statement. So if you will make any mistake in the income statement, this will come wrong. And if this comes wrong, your SOFP will not balance. So you cannot afford to make a mistake in the income statement or SOFP if you want it to balance. But you shouldn't worry that much about balancing this. Okay. You should worry about doing as many things correctly as possible. And then with practice, you will be able to balance it. Okay. That's it. I have done a simple question with you. Now we will move on to the adjustments in part number 2. Okay. And we will also solve a past paper question. Thank you so much.